So, all right, everybody, welcome. Welcome to this week's President's Meeting. Do we have a treat for you today? Today, we are going to take a slight deep dive into finances, but not exactly how you may think. This is, we very much favor, oh, hold on a second. We very much favor in our model of thinking, in our model, there's a number of isms we have when it comes to cash flow management. And we very much think of your business as a vehicle. Your business is not a goal. Your business and what it produces is not the goal. It's a vehicle to get something else. Okay, but as we start and we're going to talk about financial for just a moment, because understanding and having these few distinctions about how to use the balance sheet specifically, I'm going to tee it up a little bit with discussing some cash flow management strategies and some things that we look at, some distinctions and ways of thinking about cash flow. But you guys are going to get a heavy dose of Bill Donnelly today, one of our financial experts, and he's going to talk about how to manage your business using the balance sheet. Most of us, and the reason why that's so important is most of us met because you said to us, you're a growth advisor, great, help us grow. And what you were saying from an accounting standpoint or financial standpoint was you were probably talking about the profit and loss statement, like help us earn more than we're spending, help us bring in more and spend less. That was the underlying nature of the question you asked us. But what we are thinking about is we want to graduate you to running your business off of the balance sheet and having a full understanding as to how or what distinctions to look for or what you should be comparing. So we're gonna make you an honorary, very quick CFO at the end of this hour. So Bill, no pressure on your distinctions. You've got a few times to work them out. But let's first start with, where is your level of financial mastery? Here's our opening question. On a scale of 1 to 10, 1 is no clue, and 10 is you can hire me tomorrow as your CFO. I've got a full grasp of all financials, know how to read them, know how to create strategy and tactics from them. That's a 10. 5 would be, I can read and understand the P&Ls, and I can hold my own in a conversation, but I wouldn't be totally sure how to create them. And to be honest, I can't say I can interpret all of them and then create strategy out of them. So give yourself a ranking on a scale of 1 to 10, where you are in your level of financial mastery, financial literacy or financial IQ that way. And again, there's no good or bad number. It doesn't matter what your number is. It's just a starting point. We're just taking a pulse today, and then that'll help you understand where exactly you are and maybe what areas you need to work on. So, okay, so type your answer into the chat box, and we'll come back to that question later on with Julia after we get into the discussion a little bit. So where are we? You know, I got to tell you, on Monday, I was pretty concerned. I was looking at the map of where are the trending coronavirus cases going in the United States. And there were only 9 states that were either steady or trending downward. There were no states that were trending down more than 10%. And I was like, oh God, this is not going in the right direction. But a lot can change in a few days. And today it's actually back up to 25 states are steady or trending downward. And if things continue the way that they have been over this since Monday, that should really continue to go in that direction. And that's very encouraging. I know some of the numbers are being skewed by Florida, Texas, and California, but there's still a lot of states in number that were not going in the right direction. So I am a little bit more encouraged. We need things to be trending downward, and that opens the economy, keeps it open, and it gives us all a chance to be building our businesses accordingly. Last night was also the first session of the comeback class based on the anatomy of the comeback. We did record it for any of you who missed it or wanted to be on it, but couldn't be on it for some reason. It's totally cool. There's a recording. You can catch up on the recording. Just shoot me an email or send me a text message to our short code at 26786. We'll get you signed up for the class, get you the materials, and you can catch right up. So attend parts. We had a great first session last night. Went really well, and it tees us up nicely for the coming week. So please join us. I think you'll really get a lot out of it. Okay, so we think of cash flow as a waterfall. So our internal way of thinking of cash is that, think of a waterfall. All the water comes over the top, but then it hits little ponds, and some will flow over and hit another pond, and some will hit another pond, and not all of it that comes over the top goes immediately into the river or into the lake. That lake being your operating account. We have it stop a few ways along the way, and we'll talk a little bit about that. But basically, let's think about your business as a vehicle. Okay, so your business serves an awful lot of a lot of uses. It helps you make money. It helps give you a professional career. Gives you something to do 8 hours a day, a place to go. It's a chance for personal and professional development. It's a chance for camaraderie and building a team. It's a chance to help others and other causes. It's a chance to be a player in your community, a contributor. It gives you a sense of purpose, gives you a mission. There's an awful lot of things that your business does. But your business can also be a lead generator and a gateway to wealth. Okay, now for a lot of you, your business right now could be glorified self-employment. It could be working your butt off and not making all that much. It could be a combination of those, or you could be flying high and doing great. Right, but one of the things at a minimum your business needs to do is it needs to tee up or set you up for future success. So I have a very obvious question. I think I know the answer for all of you. But my question is, will you eat today? Will you make it through today? Will you eat? Will you have enough? Do you have enough cash in your pocket to fill up the tire if it goes low, if you pass the service station, put gas in the tank, food on the table? You can make it through today? I'm thinking probably yes. Fair? Okay. So that means yes, that means today's taken care of. You're not working. My point is, you're not working for today. You're working for tomorrow. You have money today because of something you did yesterday. But today, you are working for a future time. What is that future time, and what will the requirements be during that future time? So one of the isms, one of the things that we talk about is, as it relates to, when are you working for? If you're working today, like, I got to close this deal by this today, or I don't have a place to go to at night, different story. I don't think you're all in that position. I think you're working for some future date. And if that's the case, now you're trying to fund your future goals. My goal is to retire. My goal is to have a certain quality of life. My goal is to have certain toys. My goal is to set up my family. My goal is to set up my kids or start a business or whatever, start another business, whatever it is. Okay? And so it's more about, what is that going to cost going forward? And so as we talk about cash flow management, one of the things that we'll talk about is, give yourself the lowest amount, give yourself and your business the minimal amount that it needs to run on today. Okay? So in other words, on the P&L in your operating account, let's keep that baby as close to red line as possible. A couple reasons why. One, so you stay lean, but two, we know, and Bill will comment on this later, we know how much attention you pay to your cash when it's tight. When you've got an abundance of cash, it's like, we're good. And then you move on to other things. But when cash is tight, ooh, boy, do you pay attention. So we want to artificially make cash tight by giving you just a little bit more, tiny bit more than you need for today to run the business. All right. And then we're going to use whatever's left to build assets, to buy a building, get an insurance policy, invest in another company, use paper, real estate, and business assets as your wealth building, or what we will call your balance sheet building activities. Okay, so I'll take you through a few cash flow management principles, kind of how we think about it. And so again, think of waterfalls. You notice all the water coming across the top, but it makes a lot of stops before it gets to the bottom. All right, and we want to reroute some of that gross revenue into places that will create future wealth for you. And then we'll get some of Bill's comments as well. Okay, so the way we in black on the bottom, that's our approach. We're not you guys know what the traditional approach is. Get the money in, pay everybody out, and then whatever's left you pay and you pay your taxes, and then whatever's left over from that you then take profit. All right, well, we think about it the other way. Take the money in, let's pay us first. Let's set aside the known expenses in other accounts. And then whatever's left, that's how we're going to run the day-to-day. Because one thing we know about entrepreneurs, when it's tight, you're paying attention. When it's not tight, you lose focus. So we want to keep those accounts near red line, not in any way where you can't access it, but just it's not going to go in the operating account. If you have to go to another account, fine, we can do that. But the account you're used to working out of every day, psychologically, if it's tight, you will be tight in your controls. Okay? So here's how we think about it. Money comes in, your gross revenue comes in. Take 3 to 7% of every dollar that comes in and put it in an account called profit. Okay? Take 1 to 3% and put it into another account called the balance sheet builder. Okay? Profit and loss, and please, Bill, add on to this. Your profit and loss statement is how much money's coming in versus how much money's going out, flowing in and out on a daily basis. Balance sheet is how much do you own versus how much do you owe, meaning what assets do you own? Like, I own this building, that's on one side, and then my mortgage, what I have to pay for it, that's how much I owe on it. And then that gets me to my net worth. So Bill, any other further distinctions on the P&L versus the balance sheet?
No, that's a very simple way to put it. I think for right now, that's fine. That's fine.
See, that's how Bill gets you. That was his way of saying, Carl, you dumbass, you can't come up with anything better than that. All right, so I'll do better next time. All right. Right. And then, down here you see taxes, you see operating expenses. Where it says taxes, I could also put taxes. I could put rent. I can put PPP funds. I can put, insurance. The expenses are coming in. That could be for one of our clients. They have a fair amount of materials that goes into every purchase. Just about 20% of every one of their jobs is for hardware that goes into the installation. So they take, as soon as the money comes in, $1 comes in, 20 cents goes into the materials account because they know they're going to need it. And one of the things they identified is quicker we can get and stage the materials, faster we could do a project turnover. So we said, all right, well, let's get that money in there right away if that's what we know what it is, and that's how we budget. Commissions, set fees. We like to get those into those accounts immediately, and then whatever's left over is what you operate the business on. And you say, oh my God, why would you want to crimp our style? Why would you want to hamper us? That's not what we're doing. To give you a little bit of insight what's behind the curtain, we're trying to tap into your creativity and your innovative style. Because when there's not a lot of money and there's a lot to do, you guys all of a sudden get creative. You're like a brainstorming machine. But if there's an abundance of money in the operating expense, you get a little complacent in that area. So we like to keep that operating expense account about as tight as we can. Okay, so first things first, though, is let's make sure we have the right definitions. Okay, so see where it says step 1, analyze your financials, profitable break-even losses. We're gonna leave that alone. Bill will talk about the rolling 24. He'll talk about other balance sheet distinctions. But one of the other things that we do, and we've done this in the overwhelming majority of your businesses, but also with our clients. And if we haven't done it, let's do it together. All right, so we like to look at the chart of accounts and make sure that it's set up to reflect how your business runs. Okay, so, and we are very big on having what we would call a very accurate gross margin calculation. So we like to take, we like to take any direct costs. Okay, we talked about setting up the bank accounts. All right, so we set up those bank accounts. So step 3, adjust your chart of accounts. COGS detail, including direct labor. So in other words, we want to get everything that goes into, every variable cost that goes into building your product and getting it out the door into direct labor. What does it take to fulfill the order? What does it take to get the order in the first place? Okay, so that's sales, that's marketing, that's all direct labor payroll expenses. Okay, so if you look down the sheet a little bit, direct pay, that goes into gross margin. We put all that in there, like salespeople and anyone involved in delivering the service or who manufactures the product. But then your manager's pay, those are fixed expenses. That goes below the line in your fixed expenses. We want as much up in the top as possible because that helps you create as much variable cost as possible. We want to understand what your variable costs are. Okay, so if you build a product and you bring in raw material, that's cost of goods, right? What are the raw materials that go into that? But also, what is all the time and labor that goes into that? And not just what you're paying per hour, what are your matching taxes? What's your 401k matching for that? What is your health benefits for that? What's the insurance, what is that person's insurance policy? Anything that's payroll related goes in cost of goods sold, so we can end up with a true gross margin calculation. All right, and now there's other things you can do with that, like you can find out what is your labor efficiency, what is your sales efficiency. There's a lot of different places we can take this, but for today's standpoint, we want the distinction between variable and fixed. Variable and fixed, and we don't want to confuse the two. As a matter of fact, there's some other methodologies out there that we would argue with. We even like to put your marketing up in cost of goods sold. Get it up in your get it up in your gross margin calculation. Okay, all right. And the reason why we do that is if you are not trying to get new customers, you wouldn't be marketing. I have a colleague of mine. He's a high-level sales trainer. He does Fortune 500 sales training and consulting gigs. He doesn't even have a website. He's like, I don't need it. He goes, I have word of mouth. He goes, my deals are 6- and 7-figure deals. I do 1 or 2 a year. That's all I need. He goes, I'm already back. He goes, I'm already booked through 2021. He goes, I got more leads. I couldn't do anything with them anyway. And that's his goal. That's where he's at in his life right now. And he's in his early 60s. He's like, this is fine for me. I'm doing great, right? He has no marketing cost, none, right? So he doesn't have a website. He's got, a personal email address, and by the time you get to him and you want him to do work for you, you don't need his brochure. You know who he is. You know what he charges. Everybody's already told him he's an open book. Okay. So if he was trying to get new customers, he would do what? He would start a website. He would do what? He'd write a blog. He would do what? He would do some marketing, do some search engine optimization, search engine marketing, SEM, SEO. He would take out ads. He would do some networking, wouldn't he? Not doing any of that. But if he were to do that, all of those costs would be above the line in the gross margin calculation. His cost of sales are next to nothing. But if he wanted any new customers, anything he would do to get those new customers would go above the line. I'm spending some extra time on this because we adjust the chart of accounts on almost every client. So we can get a true gross margin calculation. So if you're making money on a particular service or product or not. Here's the other thing that it allows you to do. If you get all your direct costs above the line, you can start using ratios. You can start understanding that, all right, how many people does it take? How many laborers does it take to fulfill this many dollars worth of orders, or this volume of orders, right? So in the tech world, they'll say a common, tech support ratio is, for every tech support, they can typically handle 200 users. You go over 200 users, you need another tech support. You get more than 3 tech support, you need a manager. They've got that very well laid out. You want to do the same thing. Conversely, below the line in the fixed expenses, right? That's what payroll is going down there. Just your fixed management and administrative, general and administrative expenses go in there. So then you can say, well, how many managers do we need to support that volume of orders, and that dollar or dollar amount of orders? How many administrators do we need? You see what I mean? But if you've got it blended, now you're spitballing. Okay? You can get into some other ratios that can help you make decisions. So it doesn't matter how big you are, how small you are. Well, wait a minute, there's only 3 of us. I get it, but you probably used outsourced resources. Okay, once you get to a certain amount, there's going to be a 4th person. There's going to be a 5th, or a 25th, or a 30th, or a 50th, or a 100th. Okay, so let's get those. Let's just delineate those accounts. Okay. All right. Okay, and that's where we want to establish our percentages, as I mentioned, and you can start to let the data work for you. Okay. All right, Bill.
What?
You're on. You're up. You're over. Okay. So now, Bill. Bill will. I'll try to. I'll clean him up a bit, but I'll try to repeat some of the Bill-isms I've heard over the years, and.
There's no chance you're going to clean me up, not in this short a period of time.
I know, but I feel my civic duty to give it at least a shot.
Right.
But Bill will always say, listen, there's certain roles where you're a historian and you're looking back, but he says a lot, it's all about the future, right? And to understand, there's been a lot of talk, and if you listen to the gurus and management experts earlier on during COVID, were like, well, you can throw your projections out the window, and and that's baloney. We want to look back and we want to look forward. And there's a technique. There's a technique that Bill likes to use called the rolling 24-month analysis. Bill, you want to walk through that and some of the distinctions that you make along the way?
Yeah, sure. Thanks, Carl. Thanks everybody for being here. So what the 24-month, it's a rolling income statement and balance sheet. What it is, if at the end of June, for example, you would have all 12 months, your income statement and your balance sheet laid out, obviously to the left, and then you'd have the next 12 months rolled out by month for the next 12 months. So you'd have a 2-year view, 12 back, 12 forward. Very simply, what it does, it gives you a visual of actually what happened in the past by month and what you think, what you project, what you budget going forward. The reason it's rolling is you're going to, at the end of July, you're going to roll it a month forward, both for the projection, and you're going to take off the latest month, the last month from history. Here's why I find it really, what I find is that it really helps it helps you understand where you've been and where you're going on a month-to-month basis. Most companies tend to just look at budgeting and projections in isolation. They have one period of time of year that they're looking at it. Something happens, they're gonna relook at it. What this does is it forces you to continually look at what's happened and why it happened. That will help you project what you're doing in the future. Now, obviously in the future, you could have an acquisition, you could bring in a new line of business or whatnot, but as a foundation, and a baseline, it gives you insight into what you think revenue and profit are going to be. More importantly, and this goes to the balance sheet, it allows you to see how you're managing the assets of your business. Look, in all of my experience, and And this is why I always I look at the balance sheet of a company before I ever look at the P&L, because I know, having spent 25 years in corporate, I can change those numbers to make it sing any way I want it to. What the balance sheet is going to show me is going to really show me how we are utilizing the assets of the business. So let me give you
Bill, before you go into that, and here's one of the, we didn't get into it too much at the time other than to make the request, but one of the reasons why we said to you all, do your 12-month projection, at the beginning of COVID, is we know that you know your business pretty well. And do you realize how accurately almost all of you projected where your businesses were going to be, even in the beginning of COVID? That's why we asked you to do it, because if you go back 12 months and you go forward 12 months, now you can do trend analysis. What we listen for, what we're looking for is the further out you can project your business is the better. That tells us the better handle you have on your business. Right. And we should right now, like, I know COVID is happening, but right now we should be talking about the end of the year, beginning of next year, and into next year. We like to see that you have a good grasp of where your business is going to be at any given time, 1 year out into the future. And you guys were actually pretty accurate. In the beginning of COVID, you were like, I don't know, who knows what, but yet we forced you to do it. And almost all of you that went through the exercise, you were actually very accurate. You were getting within, say, 10% in the beginning of COVID what your business was going to be. So that's part of the reason why we like the rolling 24 so much, because we want you to go through that exercise of looking ahead 12 months, because you guys are actually very accurate in as we look back with you, you're going to find you're actually pretty accurate in what you thought the business was going to do in the next 12 months. So, Bill?
We had, excuse me, we had this discussion with a client this morning, and I said, have you guys, where does your current projection end? They said December. I said, so in the world stopping at the end of December? I said, you need to be talking about all the way through June 30th right now. You need to be looking on a day-to-day basis, because that can and will affect some of the decisions you are going to make today and in the next few months. It's so important. It's not, budgets and projections are never in isolation. They are a future look into the business. As I always say, if you guys are big enough to have a controller and a CFO, the controller is your historian. Your CFO is the one that's looking and helping to try to predict the future.
Right. And if you are a smaller company, your accountant is your historian, or your bookkeeper is your historian, and you're the forward-looking person.
That is correct.
And that's why having balance sheet IQ is worthwhile, because that's where you can really see. That's where some of the warning signals will start popping, is on the balance sheet, because the P&L can lie a lot more than the balance sheet can, I think is what you're basically saying, Bill, right?
You can make it lie. You can make the P&L lie, that's for sure. Right. You can't make the balance sheet lie.
That's true. So before we go on to some of your distinctions about the balance sheet itself, does anybody have any questions, any thoughts, any comments? You've read something totally different, like, guys, are you kidding me? I read this book and they said, no way, you don't do it that way. Or like, this is brand new to me, or I like it, or here's where we're on track or off track. Anybody have any questions before we go to the next piece? Thoughts, comments? We good? Okay. All right. So
I've confused them all.
Now you've confused them all. But Bill, we're going to find out just how confused they might be. So Julia, what were some of the answers to their level of financial mastery?
So Mike said he was a 5, but having Betty made him a 10.
No, Mike. That makes Betty a 10.
There you go.
And what's funny is Betty put 9 because she's modest.
Right. Cool. So that's okay. So rip right through them, Julia.
Okay. We had another 5. We had 2 7s, a 7/8, and a 9.
Awesome. So if any of you want, one of the ways that we can either do a finance for non-financial executives training, or you know, if you, when you review with your accountant or you do your financial budgeting each year, have us sit in on those meetings. You know, you're in the beginning, your accountant might be like, what are these guys talking about? But then when we explain what the goals of the company are and how we want to see the reporting reflect the activities, they're almost always delighted. They're like, oh my God, this is great. I finally understand exactly what you guys are trying to accomplish. I set up the chart of accounts based on the industry chart of accounts that we have, waiting for you to tell me how you might want it customized. And I've never changed them because you never asked, but they're almost always very welcoming when we have those conversations with them. So by all means, let us get involved, and we're happy to help in that area. So Bill, why don't you take us through, I mean, I've had a ringside seat at a number of these conversations where you'll talk about, we're looking at the balance sheet, we're having a discussion about it, and you'll say, wait a minute, what you just said doesn't match what the balance sheet is telling me. And you said there's certain things that you look at and distinctions that you make. And while you're doing that, I'll capture them on this, one slide. And that way, when you guys get the recording, you'll have some of those distinctions. So Bill, what are some of the things that you look for on the balance sheet to see if things are either going well, things are not going well, or there's some disparities?
So thanks, Carl. So just so you guys know, I've spent 25 plus years doing turnarounds in rapidly growing companies. I've never really worked with any company in the middle because they're kind of meandering along. So I've dealt with both sides, and both sides have very similar issues. But let me put it this: when I've gone into a new company, a new client, I always ask them, when we get to the financial review part, I always ask them for 2 or 3 years balance sheet, 2 or 3 years balance sheets. I want to see what the progression of the balance sheet has been in the last 2 or 3 years. Now, you're going to say, well, I had one potential client go, well, let me add the P&L in there. And I said, no, I don't want the income statement. I'll tell you what's happened to your business in the last 3 years just by what's on the balance sheet. And he kind of looked at me very quizzically, but then I went through it. So the first thing I'll do, I'll look at retained earnings. Very first, I won't look at anything else. I'll drop to the bottom line. I'll look at retained earnings, because what I want to know is retained earnings is going to tell me the profit or loss for the trend, okay, whether it's up or down. Then let's take the example of retained earnings have been trending down over the last couple of years. What I'll then do is I'll then look at the liability section, because what I'm going to look for in the liability section is what it's just told me is I've had a loss for 2 or 3 years in the trend. I'll look in the liability section because I want to see how they're financing that loss. Because typically you'll finance a loss, either it's going to be in your line of credit or you're going to be extending payables, okay? If that's true, what I'm going to look at then is I will go to a P&L if it's there, and I'm going to look at simply 3 lines. Again, 3 comparisons. I'm going to look at revenue to see what the revenue trend was. Is the revenue trend up? Is it down? I'll look at gross margin. Is that up? Is it down? And I'll look at total expenses. I won't get into any of the details of total expenses. I'll just look at the trend of expenses up or down and see how that is affecting the business. Because a couple of things could obviously happen. Sales are down, margins are down, expenses are up, or expenses could have maintained, but sales and margin are trending down. What I'll then look at, and I say, okay, I've got that. I'm looking at the liabilities. For those of you that do have inventory, I'm going to look at inventory then and see what the trend in inventory is, because the trend in inventory is going to tell me how well you're managing that asset. Remember this about inventory, and I've said this before. Carl's heard me say this before. I think inventory, if you are in a business where you do have inventory, that inventory is on the wrong side of the balance sheet. Inventory is actually a liability when you get it. You bought it at a certain amount, you've got to sell it, and it's a liability with carrying costs and everything else as long as you're holding on to it. So what I'll look at then is I will look at, again, I'll look at the inventory and see what the trends are. Because here's the problem. If in fact the business is losing money and your inventory is either maintaining or going up, while revenue's going down, you now have an operational problem in inventory, because what that'll tell me, what my next question would be, how much of that inventory is current and how much of it is old and is not currently being sold or is stale. Because go ahead.
On that point, because some of you are saying, well, I don't carry inventory, Bill, but think about this. Think about what he just said. I look at retained earnings, they're going down. Okay, so I got to start investigating. Retained earnings down, that's my warning sign. So I'm going to look at liabilities, all right? Is our accounts payable going up, meaning we're extending the days, or is the amount going up, or both? Are we using our line of credit, right? And then to verify that, okay, is my revenue trend going down? You know, are my margins going down and my expenses staying the same or going up, right? Then he goes to inventory. So inventory, the way you may have been thinking of it is, well, that means stuff on the shelf. We don't have that. But if you're in professional services, your inventory are your people. So you're still thinking of your people as inventory in this case, right? Not physical inventory, but in other words, if you run a professional firm, you have 2,000 hours a year that you should be billing each one of them out.
That's right.
And I know like some law firms will say 1,600 or 1,800, whatever, right? 1,600 as a minimum and all that. But every hour under the minimum, you know, the recommended amount of hours is the liability. So you're right, Bill. So you're still looking at inventory.
That's true.
That's the first place. Because you've got
an inventory of hours,
right.
And it's just like we talk about a physical inventory and its turnover. When in a professional services firm, you're talking about your inventory is your hours inventory, and it's what your utilization rate on those hours is.
Right. So exactly. So and then you say, well, wait a minute, Carl, I figured it out. We're billing the whole amount. Right. But how much revenue per hour, as Bill said, your utilization, how productive are they? Not every hour, not every producer you have, as you know, is equally as productive. So again, look at your talent as inventory as well. And so look at retained earnings, because as soon as retained earnings gets a little funky, our investigation is going straight to inventory, or in other words, your assets. Right. Are you utilizing your assets? Are you selling the stuff fast enough off the shelves? Are you billing out the rates? And are those rates bringing in profitable dollars per hour? So go ahead, Bill. I just want to make sure we made that point, because I know
thank you for that. That's a great point. So let's take it on the good side. Let's say retained earnings are moving up. Okay, that means you should be throwing off some cash. What I'd be looking at then is I'd be looking at a year-to-year comparison, a reduction in either your line of credit, a reduction in your payables. Okay. Again, I'd still be looking at that point. I'd still be looking at revenue, gross margin, and total expenses, because here's the thing, and this goes back to inventory turn and utilization rates. Okay. That's where you make your money. I can cut expenses one time, okay? Or I can, in any case, I can cut expenses one time. Where I'm going to make my money is when I utilize my asset. When my utilization rate in a service company, when that goes up, I'm actually billing more. I'm better utilizing their hours, or I'm turning inventory quicker, okay? And I'll do that. I'll make sure I do that. At the same time I'm looking at those, I'm looking at what my margin is to make sure that I am maximizing. This is where, especially in either case, I'm maximizing my utilization of that asset, and I'm making the most money on that asset because I'm producing that kind of gross margin.
Right, and when we get into inventory, if Carl Gibbons was on here, his expression is inventory is evil. And what he means by that is inventory is evil when it's not moving. Right. We love inventory when it's moving, right? But when it's not moving, it's evil. So here's a conversation we've had with almost all of you at some point, and it's the just-in-time versus the just-in-case scenario. You know, and so we walk through and we set your office or your warehouse, and we say, well, what's that stuff over there? Doesn't look like that's moved in a while. We have that just in case. Or we got a really good deal on that, so I got a whole container in of that because I got it at a good price. And we say, all right, well, how long has it been there for? And they say, well, it's been there, 6 months. And we say, okay, how much square footage does it take up? Well, it's just up on that upper rack. We don't go up there all that much. No. That's square footage. You pay rent every single month on that square footage. And we do the calculation. And by the time we're done, we're saying, you know what? You didn't actually save any money on that because you've been paying rent to keep it up there, plus time you moved it in, plus time to move it down. And you gave away all of your cash 6 months ago in order to put that stuff on the shelf. So that actually was not a good deal. And you're saying, well, it's been sitting there a while. At some point, I'm going to have to discount it. Well, if I discount it, did I really make the money on it? Right? So sometimes those great deals aren't necessarily great deals. But this is where the balance sheet analysis comes into play. So just wanted to throw that one out there as well.
I would agree. I always advise clients, don't buy it unless you know you're going to sell it. There's no such thing as a good deal on inventory. Okay. It's just
too expensive to manage.
It's time consuming, to your point. It takes up space. If you actually do the calculation, as Carl said, and you actually calculate your carrying costs, that value of that inventory is going up every month, and your margin is shrinking every month as it's going. So the quicker you sell it, the quicker you turn it, the more money you're going to make, the more money you're going to throw off.
Right on. And the same thing with a person. So now we've had this conversation with you guys before, where we have said staff to the valleys, subcontract to the peaks. One of the reasons for that is if we were to say, well, what does that person do? Oh, well, they're there for overflow. They're there for backup. They provide support. And we say, okay, well, how many hours of the week are they providing that support? Well, I could tell you that I'm confident to tell you they probably put in 32 out of 40 hours a week. Super. What are we going to do with those extra 8 hours? Do we repurpose that person? Are there any other responsibilities we can give them? Or can we let that person go and have an outsourced resource in that place so we are not paying for that extra 8 hours? Because guys, just in case is really expensive. And I'm not against just in case. But when you're doing just in case, that needs to come with a premium, and we should look at your pricing on that. In other words, if you're holding on to something for somebody just in case they need it so you could bring it to them, if you're getting paid to hold it, or they pay a slight premium because it's a short run, a short lot run, or a smaller order than normal, cool. Then that you've turned a non-core operation or expense into a revenue center as opposed to a cost center. That's cool. But we started out, I know Bill's got a whole ton of these and I'm using up all of his time, but he's only told you about retained earnings. This is one line that led to all of this analysis already. So you could see how deep we could take this. So Bill, I know there's more. We'll do a couple more. So what's another area of the balance sheet you look at? To see if something's up, wrong, or working incredibly well, and we need to investigate more.
Let me tell you what, it really is all about inventory again, whether it's hours or that's where you make your money. Now, look, we could talk about accounts receivable, how quickly you're turning that over, what your day sales outstanding are and whatnot. That's nice, but you've already shipped that. You're just waiting to collect the money for it. And that's good. You want to collect your money as quickly as possible. And the day sales outstanding calculation that any accountant can give you is a really good indicator of whether your customers are beginning to pay you slowly or not. And it's in one of our current clients, we've done a good job. We took their day sales outstanding based on some things we put together with them from about 70 days to about 58 days. And that generated a huge amount of cash. That generated over $1 million worth of cash that had just been hanging out there that they really weren't paying attention to. I mean, they were kind of paying attention to it. And when we put our foot on the floor and we pushed it, they generated about $1 million in about 6 weeks that they normally would not have generated.
Yeah.
So you've got that. And again, you've got that same client actually earlier in the year had mistakenly had bought too much inventory. And what we were able to do, because we were tracking these things and we were working with them and we were look, there's lots of different ways to look at inventory, especially physical, goods, where you can categorize them, and you've got your fast movers, you've got your medium movers, you've got your slow movers. But we were able to do that with them, and we simply focused them on, okay, what do you really need? To kind of, what do you need? What do you like? We got them away from what do you like? Well, it's nice this is the inventory I like to have. I'd like to have this. And we made them go back and look at what their utilization rate, how much they were selling of that product over the last 3 months, over the last 6 months, over the last year. And we began to identify what were really slow movers. And then we made a plan to move those out, even if it was at a discount. But the question is, remember, inventory is your cash. You've paid for it. You need to turn that. If it's not selling, discount it, get it out, turn it back into cash. Most owners, especially in a turnaround situation, I cannot tell you how many times I've sat down with an owner of the company and go, I can't sell it for that. Oh, great. Keep it on the shelf. Don't turn it into cash and continue to have the problem that you're having with it. It's not going to change unless you take some action on it. So those are the sort of things, when we get into really deep dives, we really do, once we understand what's moving, then we move to margin. We don't move to margin first. I don't care about margin until I understand what the physical goods are doing. Don't get me wrong, I do care about margin, but not until I understand how quickly it's moving. Right. Until I know what's moving, then it becomes a margin discussion about, okay, where are the opportunities in margin to move this? Same thing in service. Do we have hours that we can utilize for a client at and provide some other service that allows us to bill them out at a higher rate?
Right. So, last one. So that was a good one. So, we passed over something pretty quickly, but I think it's worth at least mentioning was, managing your business using the balance sheet does require a fair amount of discipline as well. For example, number 6 and number 7 that I put on here, are things that you want to make sure that you have discipline around. So, for example, with accounts receivable, how many days does it take for you to get paid? You want to, whether it's creating incentives or offering different terms and ways to get paid, to figure out how quickly you can get paid, and having collection procedures in place to make sure that you get paid as quickly as possible. But on the accounts payable side, it's equally as important. If you're given, if you don't have an incentive to pay earlier, then pay later. Right. And we had this conversation with a client once where they owed a vendor some money. And from a prior, this is pre us and the whole bit, like, well, I owe this person a bunch of money. But so we got them to agree to a payment schedule. And then our client got some extra cash in, and they gave the extra cash to the vendor. And we said, well, why'd you do that? He said, I felt bad. He's a good guy. He's still giving me. I said, but they agreed to a payment plan. Yeah, I know, but it's been a while. I feel bad doing it. Now, I understand that, but you were under no obligation to pay any quicker. And I don't mind overpaying if you have extra cash. But what they did was they took the money, they overpaid, and it put them in a cash crunch because they took the extra cash then, and now they created a problem with another vendor. So there's a fair amount of discipline that goes into this. When you're utilizing the balance sheet as your guide, and you're now understanding how to use it better. So don't overpay that debt unless you're required to.
So let me add one other thing to the accounts payable side of it. Remember this, especially for you owners that have personal guarantees on your line of credit. Stretch your vendors where you can stretch your vendors, because that's an unsecured liability you have, where your personal, if you start borrowing to do what Carl says, to make this money up and borrow to pay somebody, that's on you. If something happens to the business, that money's personally guaranteed at that point. Where you can stretch your vendors, especially if you happen to run into a difficult time or a rocky road, stretch your vendors as much as you can. Now, When you do that, don't go silent. Make sure that when you do that, you are constant, you are in communication with those vendors, telling them your situation, telling them what you can do and what you can agree to do. And as Carl said, just stick to that plan, but always communicate. Most vendors will give you the time if you tell them what's going on. The biggest problem I've always found is that, the person in accounts payable doesn't return a phone call. It's the worst thing you can do to a vendor. Don't return the phone call.
Right. Make sure that you have those discipline. Now, we're gonna wrap up on this point, and we'll take some slightly deeper dives on later calls. I'm just going to put a couple of, for the sake of the recording, I'll put a few actions you can take this week. And we talked about this a couple of months ago, but now is the time to revisit this with this discussion. But think about it for a moment. Where did we start the conversation? We start the conversation with saying balance sheet is what you own versus what you owe. Okay, so in other words, there's an implication that you know how to manage debt. And when you want to borrow money, who are you going to? What's one of the first places you're going to go to? A bank. What do you think they're looking at in order to determine whether or not you are credit friendly, or are a manageable risk? They're going to the balance sheet. They're going to see what is your ability to manage debt. Starting out in business, self-employment, up to $1 million, 1 or 2 or 3 people, you know what? It's a cash game. You're a cash in and out game. Totally get that. I was there too. We all started there. But at some point you graduate where it's your ability to manage credit, right? Credit you give to people, credit you get from vendors, your ability to borrow money to buy the building that you operate in or the one next to it. Okay, your ability to build your asset base, because all the people who like to invest and who like to loan money love the balance sheet. They're playing the balance sheet game, right? As well as the P&L game. I don't want to say that P&L is useless here, because it's not. It's important, right? Because that shows how you manage your cash. This also shows you how you manage your credit, essentially. They want to see the whole picture. But how many times have we heard, wow, this is great. Look what the projection are, and you're talking P&L. It's like you're bringing a knife into a gunfight, and you're like, I'm going to talk to that investor or that bank, and boy, we're going to convince them. And your balance sheet is either non-existent or it's a mess, right? So we want to make sure that this is a very valuable document if you're going to build long-term wealth, okay? And your business is your gateway to long-term wealth. Right. So again, I'll wrap up with this point, but then we'll do a couple quick takeaways and then we'll let you guys go for the rest of the week. But think about how we use the business for long-term wealth. Think about what's the next chapter of your life going to be about. And if and when you retire or you slow down your pace of work and you want to get into other personal hobbies, what would you do and how much money you're going to need, right? And would those assets the assets you have today, are they sufficient? Are they sufficient to throw off passive income? Are they sufficient if you sold them, you would have you'd have a good windfall? Or, if you were to, or if you needed to borrow against them, could that create some opportunities for you? If the answer is no, that's where you've got to get to. And we like to think of balance sheet building as a 15-year exercise. All right. Now you could build your balance sheet in 1 year, 2 years, 3 years, but in 15 years, that little extra that you could shave off of your salary, shave off of some of the things that you take as personal benefits, and you got yourself a key man insurance policy. You invested in a couple of company stocks or mutual funds, or you added to your 401k, or you bought the building next door. In about 15 years, you'd have it all paid off, right? I'm not saying that this is the only way it works. It could be a 10-year horizon. It could be 20, 30, whatever. But kind of think in terms of 15 years, all right? In 15 years, where are you going to be? How much money would you want to have? I know how much I want to have, all right? So my plan is over the next 15 years, I'm going to spend the next 15 years accumulating assets. And then at that point, I'll either keep them or I'll spend the 15 years after that selling them off. All right, that'll take me to 84. Okay, So far, so good. I'm good up to that point. So start thinking about it in those terms. All right. I'm in accumulation phase now. I'll go into distribution at some point and we'll talk about that. But think of your business as the gateway and the lead generator. The gateway meaning it provides me enough cash I can reinvest into an asset. Right? Think about what you need today to eat. What do you really need? Okay? I'm not suggesting you artificially reduce your quality of life. I'm not saying that. But just look at what you actually need. Anything above that, put it into asset building. Asset building, asset building, asset building, asset building. Okay? Build up your balance sheet. Let's get balance sheet acumen going. And then we're going to use that as our tool going forward so we can say, yeah, my balance sheet's looking really good. Keep your P&L where you're making a little bit. You don't need to be this, right? You know, just that operating account is a little bit more than what the expenses are, and build the profit account, build our balance sheet builder account, and we're going to take that money and that's where we're going to build our wealth. Okay. So this was kind of part one. We'll dive into this more in future calls, but we want to set the agenda. The reason why this is such an important conversation is now that we are post-COVID, we're in the middle of COVID. We know what it is. We know where it's going. We are entering the biggest garage sale of assets, assets that will be distressed assets and assets available for the next 5 to 9 years that are going to be offered at a discount. And if you look at one of the top wealth building strategies of the last huge corrections, 2008, 1929, right? The most millionaires and billionaires were created during those two times. And the secret to what created those millionaires and billionaires was their ability to purchase assets. You know, you'll read, oh, they had liquid cash and they bought this. And they were able to, but at the end of the day, it was their ability to accumulate assets. They bought distressed companies at a low rate. Remember during 2008, 2009, Warren Buffett bought Bank of America stock at $5. $5. What is it, like 34 now? Something like that? $5, guys. 5. Fourth biggest bank in the world. $5, right? So, but he had the money to do it. We want to do the same thing. So minimize what you need for today. It's available to you. You're buying the assets. You can always sell them. You own them, right? But let's build that balance sheet. Okay. All right, cool. So, guys, we're at the top of the hour, so we'll let you go. This is one of those discussions that we want for you. This is one of those things we'd like to see you build that wealth over time. So we'll let you go. Enjoy the rest of your afternoon. We'll see you up on the upcoming president's meeting in 2 weeks. 2 weeks. And if you haven't yet signed up for the comeback class, by all means do that. We'll get you in there for the next class, and we'll see you all in the next call.
Thanks.
Have a good